we are doing in very different things nowadays. And why I thought I should agree to come here, because we central bankers, especially supervisors and regulators, we avoid talking too much, but there is a purpose which can serve here. One was the persuasive capacity of Mr. Jamal. So he was not in the mood to be told no. And second is, I thought this collections and recovery also has a distinct bearing on the health of the financial sector. Correct? So I thought this is the time we can tell you something, what is around, what is happening around this literature of surveillance of financial sector for the new generation. And here, obviously, if I will not tell about how you should collect these things, but for resilience of the financial system, that is a very important thing. But one thing which she didn't tell again is there are also borrowers who have the ability to pay, but they don't have the willingness to pay. So how to handle those who are unwilling to pay despite having ability to pay, that you have to discuss. So that is a discussion for future in next 2 days. I don't know who should be able to speak on that. But what I will tell you is, as I have coined my name, so from a narrative of managing risk, the narrative has changed towards achieving resilience. What is that? So I will tell you the headline first. From a post-mortem kind of surveillance of the financial system with which all the citizens of the world have become obsessed with, they don't like it anymore. Why? Because a post-mortem is always a post-mortem. And that is where we do supervision. So an attempt is being made to switch over to a pre-mortem kind of surveillance, and which is a new experiment, a new work being done by Reserve Bank of India, Department of Supervision, for the first time in the literature of supervision. So I thought that is what I should indicate to you, that is where you all have to contribute so that the citizens will sleep and live peacefully. Okay? So what is resilience? Because you are pursuing the cause of stability, and the definition of stability in the literature is absence of instability, and the definition of instability is extreme volatilities in any part of the financial system. And the parts of the financial system are, I am quickly telling these things. So those who are interested to do research on this should read my book, what she told. See, in the book this concept had come. We have tried it out at RBI in India, and we have been successful. So now this College of Supervisors is being created to bring the supervisors all over the world to Mumbai and to tell them they should also learn and remain in the same platform as the Indian supervisors and regulators. Anyway, that is the other part. So instability means extreme volatilities in any part of the financial system. And financial system, to your surprise, are 4 parts. You are working in one part. See, other 3 also are equally important, I will tell you. One is macroeconomic system. You will be surprised why I am telling the macroeconomic system is a part of the financial system. I will tell you at the end. Second is financial institutions like banks, NBFCs, insurance and all that. And you may be, now you guys are taking a place in this area, like outsourcing or platforms and all these, a part of the financial innovations created in functioning financial intermediation. Third is financial infrastructure, payment system, deposit insurance and all that. And then financial markets, forex market, securities market and all that. So now, why they are interconnected? Why macroeconomy is interconnected with financial institutions. I will just give a simple example since I have only 20 minutes and each one is a session. So I will not be able to explain so much, but I will give simple example to make you to understand. If growth rate falls, what will happen? So the producers which are producing goods will no more get incentivized nor encouraged to produce more. So if by chance they are your borrowers, any bank's borrowers, their ability to repay in time, you are dealing with that, will fall considerably. So you are all talking about recovery. So they cannot recover if macroeconomic condition is poor. Correct? So this point also should be discussed. Then NPAs of the banks will rise and there will be problem in the financial sector. So this is how they are interconnected. And the problem in a bank starts and they are interconnected with NBFCs in India. So they will also give the problem to the NBFCs or vice versa. And payment system, if there is any problem anywhere, first and two will get affected. And so is the market. So interconnectedness is a lesson we learned from the last global financial crisis. But what we forget is we all were wrongly taught about a very important definition in the literature of financial economics that is called management of risk. What you were taught in your textbooks, it is identifying, measuring and managing risk. And the corollary of this statement is what cannot be measured cannot be managed. So you will all agree with me, my dear friends, we have not been able to measure risks, but still we are claiming we are the best managers of risk. Wrong. We are only monitoring risk, not managing. And I have added to the literature of definition of financial management one item. That is what I will discuss. It is smelling, identifying, measuring and managing. So smelling is the latest addition to the literature of management of risk. What does smelling means? Identifying vulnerabilities in any pocket of the players for financial intermediation in advance, well in advance, so that we remain at the state of distress and don't go to the state of crisis. Again, the literature you would have read is only crisis. Literature recognizes one word that is called crisis, but it doesn't happen that way. It starts with a distress, snowballs into instability and then goes to crisis. And what the current narrative emphasizes is we will not allow the financial system to go beyond a state of distress. Forget about instability, definitely not crisis. So smelling distress in advance is the new narrative of the supervisors and regulators at Reserve Bank of India. And that is what we are trying to not teach, share our experience with other supervisors of the world. And that is what College of Supervisors is doing, and is a new initiative by the Reserve Bank of India and as a G20 initiative. And as we know, we are claiming to the Vishya Guru. Okay? Vishwa Guru, for non-Indians I'm telling. So we don't have the inhibition to share our experience with others. So we are the country who have framed Vasudhaiva Kutumbakam as well. No other intelligent guy will share his expertise with others. You will not also do your expertise with your neighbor. See, the only place that is India and Reserve Bank of India, which has made an endeavor to share our experience with the world, where the following will be done. So I will tell those following and conclude. Okay. So the first thing any act of financial intermediation is, as I told you, risk appetite. We don't know how to manage risk, how to measure risk. We also don't know what is my appetite for risk. Still I am going ahead. And you will be very glad to learn what is the raw material of the game of finance. Capital is there, deposits are there. No business can start without raw material sources being lined up. Correct? What is the raw material of banking? It is risk. How and all I cannot explain today. So you take it from me, because last 3 years this book is in the market. Nobody has challenged me. So let us see. So my definition is the correct definition. Okay. So by that. Like smelling being added to risk management. And this one, as I told you, raw material for financial activities is risk. So that means risk monitoring or management depends on the risk appetite of individual institutions. How much I can eat, you may not be able to eat. So that means my appetite for risk as an institution will definitely differ from somebody else's. Point number one. And second, it has got to be dynamic. When I approach a chapati, I may take one. But when I approach a rasgulla, I may take 5. So it is dynamic. Appetite, risk, appetite is equally dynamic. And most importantly, it has also been revealed out as a lesson of the financial crisis, risks themselves are interconnected. Again, I will explain through an example. If there is extreme volatilities in market risk, meaning thereby either there is volatility in the exchange rates or in the interest rates, then only market risk will come. So that will have a definite bearing on the performance of the borrower in their capability to repay. So again there is a link. It will lead to counterparty credit risk. So, in the very literature of management of risk has become very cumbersome because of this. You are trying to measure credit risk. Then you find, and also market risk individually. There you find they both are also interconnected. So it has made the job very difficult. But the good point is, we have been able to, in Reserve Bank of India, measure interconnectedness between banks and NBFCs. So the fact that we have been able to do it means the current literature of AI, ML and econometric modeling allows us the wherewithal to measure risk. So my request to all of you, we pretended to have managed risk for all these years because there were no techniques and tools to measure and manage them. But here is the time in the changing dynamics where techniques and tools are available to not only measure risks but also to smell them. And in your parlance, you should also be able to identify the vulnerabilities of borrowers. You will be surprised and pleased to learn, sitting at RBI, we are able to identify vulnerable institutions as also borrowers, because of the acrylic data we have. And that is what is your conference about. If there is vulnerability in the counterparty who is expected to pay, so he will not pay. But you should not know it only after he doesn't pay or he expresses his willingness to pay, non-willingness to pay. You should know it in advance. And for that, you require 2 things. Your company or whoever must get to know these 2 things. One is realistic early warning mechanism with a threshold there. And second, forward-looking stress testing. And how they have to be done, only experts can tell you, or I can tell you, or you have to read and learn from my book. So this is the message from the supervisor and regulators from this country. The pioneer work we have done. So with this, I will set the theme for this conference where we will not only think, because all the sponsors I see are able to guide on the techniques and tools. But I don't know whether they are able to use the techniques I told you. That is using AI ML, doing early warning mechanism and forward-looking stress testing. If they don't, so my appeal to them as well, the sponsor, gold and silver, he had a huge list of them. They should learn that to make your business resilient. and you should learn how to identify the potential or possible unwillingness or inability of the borrowers to repay. Thank you very much. Namaskar.